Americans now owe a record $18.6 trillion, with nearly 70% living paycheck to paycheck, yet somehow spending just keeps rising. If most households are sinking in debt, who is really fueling this relentless consumption, and how long can it last? The answer reveals a divide and a hidden engine few are talking about. Total household debt in the United States has reached $18.6 trillion, according to the latest Federal Reserve data. That figure includes everything from mortgages and auto loans to credit cards and student debt, reflecting a steady climb quarter after quarter. On average, Americans with active credit files now carry about $63,000 in personal debt each, though this number varies widely depending on age, income, and region. Mortgages make up the largest share, but non-housing debt, including credit cards and auto loans, has grown at a faster pace in recent years. Despite these mounting obligations, consumer spending remains the main engine of the United States economy. Nearly 69% of gross domestic product comes from household consumption, goods, services, and experiences paid for with a mix of cash, credit, and increasingly, installment plans. This pattern has held steady even as debt loads have climbed and savings rates have slipped back to pre-pandemic levels. The paradox is clear. Americans are more indebted than ever, yet their spending keeps powering the economy forward. The numbers show a nation deeply reliant on borrowing, with the scale of both debt and demand at historic highs. Not all spending power is spread equally. While headlines show consumer spending at record highs, the real engine behind those numbers is surprisingly concentrated. The top 20% of American households, those earning well above the national median, are responsible for nearly two-thirds of all consumer expenditures. According to Bureau of Labor Statistics data, this group accounts for about 40 to 50% of total income, but their share of actual spending is even larger, approaching 65 to 70%. That means the familiar image of a nation of big spenders is, in reality, being driven by a relatively small slice of the population. For everyone else, the picture looks very different. Nearly 70% of Americans now report living paycheck to paycheck. Surveys show that this is not just a problem for low-income families. Even many households earning $100,000 or more struggle to keep up with monthly bills and unexpected expenses. Essential costs, like car repairs, medical bills, and groceries, often force families to reach for credit cards or installment plans just to make ends meet. For these households, spending is less about luxury and more about necessity, with little cushion for emergencies. This divide creates a strange paradox. Aggregate spending remains strong, buoyed by high-earning households, while financial stress spreads across the broader population. The numbers on paper can look healthy, but underneath, millions are stretching every dollar, relying on credit and hoping the next paycheck arrives before the bills come due. At the checkout page of thousands of online stores, a new button now sits beside the old standbys, labeled Pay in 4. With a single click, a $200 purchase transforms into 4 payments of $50, typically stretched over 6 weeks. The first installment is due today, and the rest follow automatically, debited from a linked debit card or bank account. Approval takes seconds, requiring only basic information, often just a name, date of birth, and email. No hard credit check, no paperwork, and for most Pay in 4 plans, no interest if payments arrive on time. This frictionless process is by design. Major providers like Affirm, Afterpay, and Klarna have built their systems to blend into the background, making the act of borrowing nearly invisible. The merchant gets paid up front, minus a fee that can run higher than standard credit card processing. For shoppers, the full cost feels distant, a series of small, manageable bites instead of one large charge. What is less obvious is how these obligations slip past traditional credit tracking. Most Pay in 4 loans are not reported to the major credit bureaus. That means the balances do not show up on credit reports, and lenders cannot see the true scale of a person's short-term debts. According to the Consumer Financial Protection Bureau, Americans took out more than 335 million buy now, pay later loans in a single year, totaling $45 billion, with the average loan just $135. Heavy users can juggle 10 or more active loans at once, often across multiple providers. Yet because these debts are scattered and largely unreported, both consumers and regulators may underestimate the risk. As one buy now, pay later executive put it, we are offering flexibility for customers, giving them more ways to budget without the barriers of traditional credit. But the real picture is often more complicated, and the debts more hidden than they first appear. Maria stands in her kitchen, scrolling through her phone as her 8-year-old son finishes homework at the table. A holiday sale banner flashes across her screen, the gaming console he has been asking for. Now, $250 with a new option below the familiar credit card logos, 4 payments of $62.50, interest-free. Maria hesitates, checking her checking account balance, just enough to cover groceries and the next rent payment. But the first buy, now pay later installment would only take a small bite today. The rest, the app promises, will come out every 2 weeks automatically. She enters her details, name, date of birth, and email. Approval is instant. The console ships out the next morning. For Maria, the purchase feels almost painless. There is no credit card limit hit, no lengthy application, no warning about her existing debts. The full price fades into the background, replaced by a series of manageable numbers on her bank calendar. When the package arrives, Maria feels a wave of relief and pride. Her son will have the gift he wanted, and she has not maxed out her credit card. The app sends gentle reminders of upcoming payments, each one timed to hit after her next rideshare deposit. But the margin is thin. If a payment hits before her paycheck clears, her bank could charge a $34 overdraft fee, more than half an installment. For now, though, the future feels distant. Today, Maria has what she needs, and the bill feels far away. A flash of excitement, a tap of the finger, and the purchase is done. For many Americans, this moment delivers a real chemical reward. Behavioral economists call it a dopamine hit, the brain's way of reinforcing actions that feel good even if the consequences come later. When money is tight, that rush can be even more tempting. Retail therapy isn't just a phrase, it is a coping tool. Research shows that people under financial stress often spend more on small treats to manage anxiety or regain a sense of control. The relief is immediate, while the pain of repayment sits somewhere in the future. This is known as present bias, the tendency to favor short-term comfort over long-term stability. Social media amplifies these urges. Curated feeds and influencer haul videos set new standards for what it means to live well, making it easy to compare one's own life to carefully staged highlights. The pressure to keep up, even when budgets are strained, fuels more spending. Consumer sentiment surveys show that confidence is near recession lows, yet the urge to buy persists. As one behavioral economist puts it, your brain craves the quick dopamine hit from buying, ignoring future pain. It is emotional regulation gone wrong for those living paycheck to paycheck. In this climate, spending becomes less about want or need and more about managing stress and belonging, even as the risks quietly build. In early spring, the numbers turn stark. The New York Fed reports that 4.5% of all household debt is now delinquent, with serious delinquencies, accounts more than 90 days past due, rising across credit cards, auto loans, and student debt. The average credit card balance has climbed to $6,523, while personal savings, once padded by pandemic relief, have dwindled to their lowest levels in years. For Maria, the pressure finally breaks. An automatic buy now, pay later payment hits her checking account 2 days before her rideshare deposit clears. The result is a $34 overdraft fee, followed by a cascade of late charges. Her credit card minimum jumps, and a past due notice appears in her inbox. Groceries and rent cannot wait, so she uses her card to cover the gap, pushing her balance even higher. By the end of the month, Maria is juggling overdue buy now, pay later installments, a rising card balance, and a dwindling bank account. The stress becomes too much to manage alone. She calls a nonprofit credit counselor, who listens, then opens a spreadsheet to tally every obligation, cards, buy now, pay later, utilities, and rent. The counselor explains how the debts interact, how missed payments can trigger more fees, and how quickly the math can spiral. Together, they outline a debt management plan, renegotiating interest rates and setting up a realistic monthly budget. It is not a quick fix, but for the first time in months, Maria sees a path forward. one built on facing the numbers, not hiding from them. Right now, nearly 70% of Americans spend more than they save, as easy credit blurs the true cost of living. This cycle isn't just about numbers, it's about choices made under pressure and hope. The bill always comes due. What happens next affects us all. Share your thoughts below.